So how much of the money that you're currently saving for retirement, how much of that money will be tax-free, tax exempt when you go to take it out in the future? Well, in this video, we're going to highlight 4 reasons why you may want to contemplate adding tax-free income to your retirement strategy. My name is Jason Kennedy. I am the founder of the Kennedy Financial Group, and for the past decade, we have been working to help medical professionals and educators and others to increase their retirement income and create better financial outcomes for them. And I know what you're thinking. You're probably thinking, if a person had to choose between tax-free income and taxable income, why would anyone ever choose anything other than tax-free? Believe it or not, the majority of Americans currently have the overwhelming majority of the money they saved in tax-deferred vehicles. That means that that money is not going to be taxed until they go to take it out in retirement. So they might think it's just their account, but they are unaware of the fact that they're actually business partners with the IRS. Now, paying taxes isn't bad. When we pay taxes, one is the law, but we receive certain benefits from doing it. But the government does allow us to choose whether we want to pay taxes now on the money that we save, or whether we'd rather let that money grow and pay taxes on it later. We're going to highlight some reasons why it could be more beneficial to go ahead and pay those taxes now. Now, the first reason why it could make sense is because taxes are actually on sale right now. Now, what do I mean by that? Well, if you look at the history of tax rates, going all the way back to about like 1914, and you just follow tax rates through history, if you look at this chart, you can see tax rates have been far higher in the past than they are right now. Tax rates have been as high as 94%. And throughout the majority of history, as you can see here in this chart, they've been above 60%. Where are tax rates now? They're in the 30s. And so a person has to ask themselves, do I believe taxes are going to go up or down? Well, when you think about how much debt the United States is currently in right now, we have more than $27 trillion of debt. The government only has 2 ways to pay off this debt. They can stop spending money, or they can raise taxes. So if they're going to raise taxes, if that ideal is even out there, we have to start to examine whether we want our money in a position where it could be taxed, or whether we want to take advantage of the current sale by paying taxes when they're low. The situation we're in could be illustrated this way. Think of a gas station. You find out through the news that gas is getting ready to go up. Gas prices are going to go up tomorrow. Well, what would you do, right? Wouldn't you try to fill up your tank, right? Maybe fill up a couple of other tanks, take advantage of the lower prices for gas, because you know tomorrow they're going to go up. Well, shouldn't the same principle apply to our retirement if we believe the taxes are going to go up? Yeah, most certainly it should. So that's the first reason why a person might want to go ahead and pay taxes now and have their retirement income be tax-free. Now, the second reason why it may be beneficial to pay taxes now and let your retirement be tax-free is because it's a chance that you'll end up paying less in lifetime taxes. Now, for me, I've always been a big math person. And so when I was presented with the idea of saving for retirement in a 401k or a tax deferred account and saving for retirement in a tax-free account, my brain instantly went to the math. Right? How much taxes are we talking about? Knowing that could help me to make a decision. So you may have to calculate the numbers for yourself. You may have to calculate, how much am I really saving each year by deferring my taxes until later? And how much will I pay each year when I go to take that money out to spend it to support my lifestyle when I'm no longer working? Now, we chose an example. Obviously, this is not your example, but it is designed to illustrate the point. We chose an example of a couple making about $150,000 a year, and they're saving 10% of their money for their retirement. So that's about $15,000 a year. Now, the IRS will give them a tax credit or tax reduction, should I say, not tax credit, tax reduction of $3,300. So that's how much they save each year, right? So they're probably excited that they're saving that $3,000. If you multiply that out over a 30-year time frame, they're saving about $99,000. That's how much they saved in lifetime taxes. Now, what happens when they now enter retirement and they decide that they want to live off of their savings?
So let's say their goal is to have, we'll just say maybe 115, 120,000, somewhere in that ballpark. Let's say that's the amount of money that they want to have when they stop working. And so if they desire to have about $115,000 worth of income, how much will they be required to pay in taxes? Well, each year, they'll be required to pay about $10,291 in taxes. In 10 years, they will have paid $102,000 in taxes. In 20 years, they will have paid $205,000 in taxes. And in 30 years, they would have paid $308,000 in taxes. And this is not even including the amount of state taxes that they would pay.
Do you see the point? Right? They're paying more in lifetime taxes just to defer paying taxes right now. But it gets worse than that. What if they don't want to lower their income? What if they want to keep their income where it is? Well, they'd have to pay more taxes. What if a mate passes away and they are still required to take money out of these tax deferred accounts? That's called required minimum distribution. The government says it has never been taxed, so you need to take a certain amount every year. Well, because they're no longer married and they're in a single tax bracket, they're going to have to pay more money in taxes. What if they have an emergency expense and they need to take out a large sum? What if there's a long-term incident or long-term care incident that requires them to access their money quickly? And what if taxes themselves go up? See, all of these different scenarios could cause them to pay more in lifetime taxes when they stop working. Now, the third reason why it may be better to aim for tax-free retirement is because you have less risk to your retirement portfolio if you can just eliminate taxes. I mean, think about all of the risks that a person has to endure as they plan for retirement. They have to deal with longevity risk, the risk that they'll live too long. A person has to contend with market risk, the risk that the market will crash at the wrong time. They have to deal with the sequence of return risk, the risk that the order in which they get returns on their account will lower their ability to access those funds and use it for themselves, and a host of other risks that we really don't have time to mention. The point is that part of retirement planning is just trying to cross off as many risks as possible. And if you can take tax rate risk off the equation by having tax-free money, then you're going to have more peace of mind and more confidence when you finally decide to retire. The final reason why a person may want to have tax-free money in retirement is because it allows them to provide a better gift or better legacy to their heirs. I was just talking with a client last week, and that was one of their main goals. They want to be able to leave some money behind to their family. That's important to them. So if you've saved up this money and you decide you want to leave it behind, the old rules used to be that your family could inherit those funds and they could spend them however they see fit. They weren't required to withdraw all the money right away. They could withdraw it gradually. And the reason why that was beneficial is because anytime you withdraw money from a qualified account, you have to treat it as income. It's taxed. So a person in the old scenario could control how often and how much of the money they withdrew, and as a result, keep their tax rate lower. But those rules have changed. Now, unless it is your child who's a minor or a mate. And maybe there are a few other scenarios, like if a person is disabled, they can access your money without any type of restrictions. But traditionally, like if it's a grandchild or something to that effect, and they inherit your funds, they have 10 years to spend that money. If they have to spend all of the money inside of that IRA or 401k or 403b in 10 years. Why is that a problem? Well, it can push your child into a higher tax bracket. So if they're making like $80,000 a year and they withdraw 50,000 because they have to, they just push themselves into a higher tax bracket. They're paying more taxes on even the money that they make. But if that money was in a tax-free position, none of those rules would apply. The beneficiary can withdraw that money however they see fit at whatever pace is comfortable for them. So we've just highlighted some reasons why a person might want tax-free income as part of their retirement. The question is, how do I get it? Where do I go to get tax-free vehicles to save for retirement? Well, really, there are not that many. One place a person could go is they could investigate or look into all accounts Roth. That's your Roth IRAs, your Roth 401ks, Roth 403bs, and even Roth conversions can kind of fall into that category. See, anything with Roth attached to it means that you're going to pay taxes now and have the money and the growth that the account produces all be tax-free. The second place that you can go to get tax-free money is actually life insurance. Now, we're not talking about the normal type of life insurance that you use where you pay a small amount and then you get a death benefit that pays out to your family. No, we reverse the order, right? We squash the death benefit as low as we can make it go. We squash the internal fees, and we're able to dump extra money into the life insurance's savings account, which is called cash value. Everything that grows inside of that account is tax exempt, right? Has the potential to be tax exempt. And so that's another place where a person can go to be able to create tax-free income. So the point is that regardless of how you go about doing it, it's worth considering adding tax-free resources into your overall retirement strategy. So hopefully this video helped. Hopefully this video inspires you. Hopefully it motivates you to stop what you're doing and look at the money you are saving for retirement. Don't let the ease of being on automatic pilot stop you from checking to see how your money is being saved. If all of your money is being saved in a tax deferred position, there's a possibility that there might be a benefit for you to look into tax-free income. Obviously, if I'm not your advisor and you don't work with me one-on-one, I don't want you to take this advice by itself and make decisions based on it. But if you need my help, you can book an appointment with me one-on-one right in the calendar link in the description. And I'm happy to discuss some of these options with you in more detail. If you appreciated this video, give us a like. Let us know in the comment section. Subscribe if you have not done so already, so that you're aware when we release a new video. And hopefully, like I said earlier, this video will motivate you to look into some of these tax-free options. Well, I hope that this video finds you well. And until the next time we meet, till the next time we talk, take care.